Thank you for joining us. Tonight, we are delighted to bring you this program on Social Security 101. My name is Barry Erickson, and I'm Community Engagement Coordinator here at Wheaton Public Library. With us tonight, our presenter is Renee Boyle. She is a financial planner with the Dala Group, a financial advisory firm in Hoffman Estates. Thank you so much for being with us tonight, Renee. I'll hand the screen over to you.
Thank you, Barry. Well, thank you so much for coming tonight. Just to give you a quick overview of what we're going to be talking about this evening, we're going to start by talking about the outlook for Social Security. Then we're going to move into who is eligible for Social Security. We're going to talk about some filing strategies. We'll take a look at a Social Security statement. We'll talk about spousal benefits, ex-spousal benefits, survivor benefits. We will spend some time just briefly touching on the windfall elimination provision and government pension offset, which apply to people who receive public pensions. We'll talk about retroactive benefits, reductions for working while collecting Social Security, the taxation of Social Security, and then we'll end with how we can help. So before we get started, I just wanted to take a second and introduce you to my family. My husband, Brad, and I have two daughters. Our oldest daughter is up here in the upper corner, and her name is Rebecca, and she just got done celebrating her first wedding anniversary. She got married last October, and with her in the picture is her husband, Brendan. And they live in St. Louis, and Becca is also a financial advisor. So that kind of runs in our family. And then our younger daughter is next to me in this middle picture right here. Her name is McKinley, and she is about to graduate in May from Cedarville University in Cedarville, Ohio. And she is majoring in youth ministry. So now she is interviewing for jobs to start in the summer for her first full-time real job. And then you will see two younger girls here in the middle between Brad and I, and then again over here on the side playing in the snow. And they were a bonus that came with Brendan, our son-in-law. And so we now have two granddaughters, and their names are Sophia and Naomi, and they have brought a lot of joy to our lives. Plus, it's been exciting because they grew up in Texas. So the first time they came to visit us, they had a nice big snowstorm. So they were able to play in the snow for the first time. So that was fun to be able to enjoy that experience with them. Now, I have always been interested in helping people with their finances, but it became even more important to me to help people who are either in retirement age or approaching retirement age a few years ago. And that is when our elderly neighbor down the street passed away, and she left behind her disabled son, Alan. And that is Alan down in the lower corner down here. And after she passed away, it quickly became apparent to us that the plans that she and her husband had put in place for Alan were no longer going to be viable options. Now, while they had saved and invested very well, they had not updated their estate documents in over 30 years. So what would have worked for Alan 30 years ago clearly was not going to work at this point. So myself and my husband and another set of neighbors who live right across the street from Alan have kind of brought him into our families. And so we help him with his shopping. We make sure he gets to the library once a week. We make sure he gets to his medical appointments, we help him with his finances, take him out to eat or to a baseball game once in a while, those kind of things, so that he can still live as close to the same life he had before as possible. But it was a really sobering thought to think of what would have happened to Alan if we wouldn't have been around to help him. So that's why I really am passionate about making sure that people have all of their finances and estate plans and all of those things in order so that they're in order both for themselves and for those that they leave behind. All right, so let's get started by talking about Social Security's outlook. So, according to the last trustees report, Social Security should have enough resources to pay 100% of benefits until 2034. Because in 2034, that is when the trust fund reserves are expected to run out. So that means that in order to balance the system, Social Security benefits, whether they're just regular Social Security benefits or disability benefits or survivor benefits, would need to be cut by about 20 to 22% in order to balance the system. And by that, I mean that the amount of benefits coming in or taxes coming in from people's paychecks when the taxes are withheld from their paychecks would match the amount of benefits going out to the recipients of Social Security. Now, the question is, will a 22% increase really happen? And the honest answer is we just don't know. Congress could decide to do something soon to fund Social Security so that those cuts don't need to happen. They could wait until 2034 and then decide to act. They could just let the decrease happen, or they may come up with some creative ways to make Social Security last longer. Like, for instance, in the past, when the Social Security benefit age used to be 65 for everyone, and then they gradually increased it to now those who are younger, their full retirement age is age 67, and then there's some gradual changes in between depending on when your birthday falls. But they could decide to do something like that where they extend it further. The answer is we really just don't know. But you can tell if you look over here why this has become a problem. Back in 1950, we had 16 and a half active workers for every one beneficiary of Social Security. Now in 2022, we have 2.8 active workers for every beneficiary of Social Security. So you can understand why this has become such a problem. All right, let's talk about who is eligible to receive Social Security. So there are 4 ways to become eligible to receive Social Security. The first is by being an eligible worker who has accumulated a minimum of 40 work credits, and we're going to come back to that one in just a second. Then you could be the spouse of an eligible worker, an ex-spouse of an who was married to an eligible worker for at least 10 years, or the surviving spouse of an eligible worker. Now, those last 3 are what will be coming up in a few minutes, but right now let's concentrate on that first one. So 1 work credit in today's standards, in today's dollars, is $1,510. So if you've earned $1,510 in a quarter, then you have earned 1 work credit. And the maximum amount that you can earn in 1 year is 4 work credits. So if you've earned a little over $6,000 in a year, you've earned the most work credits that you can earn in that year. Now, your actual benefit that you receive is going to be based on your 35 highest earning years. So they will take an average of those highest earning years, and that's how they will come up with what your Social Security benefit will be. Now, again, that doesn't mean that you have to have worked for 35 years. If you have worked for at least 10 years to receive those 40 work credits, then you are eligible to receive benefits. What they will do if you've worked, say you've worked somewhere more than 10 years and less than 35 years, then they'll just average in a 0 for each year that you haven't worked up to 35 years. If you've worked more than 35 years, then they're going to take the highest of however many years that you worked. They'll look for the highest 35 years and they'll average those earnings together. And just so you know, those do not need to be consecutive. So for instance, you could have worked and have one of your highest earning years, then taken a break to raise a family, or you may have had an illness or something like that, and then gone back to work. And if those highest earning years are on either side, then that's okay. Those still count as some of your highest earning years, and those will be averaged in. Now, before we go on, I'm just going to take a quick break to see if there are any questions before we go on. Barry, do we have any questions that I need to address before we go on?
Someone was just asking where to put the questions, but we don't have any questions at this point.
Okay, I just saw the chat come up, so I just wanted to make sure that I wasn't missing something there before we go on. Thank you.
Yeah.
All right. So let's take a look at a Social Security statement. So this is what a Social Security statement looks like, and we'll go into that in a little more detail. But first, I want to let you know that if you haven't already done so, I recommend that you sign up at ssa.gov for a Social Security account, and there'll be a place that you can click to sign in if you already have a Social Security account, or sign up if you don't. Now, you might notice that it used to be that Social Security would send out these statements once a year, but now they do not do that. So you may still get one if you're over age 60 and you've never signed up at ssa.gov. They may still send you one in the mail, but other than that, they really don't send them out by mail anymore. And we're going to talk about in a minute why that's really important. But I would encourage you, if you've never done that, to visit ssa.gov and sign up for an account, and you will be able to see your current statement when you do that. There'll be a place where you can click see my full Social Security statement, and you can get that and even download it to your own computer or print it out if you want to. All right, let's talk about what you're going to see on that statement. So the first thing it's going to tell you is what your full retirement age is. So if you look over on this left side of the screen here, it says your full retirement age is 67 based on your date of birth, April 10th, 1960. So when you're looking at your own statement, your birthday will be on there, and it will tell you your full retirement age if you don't already know that. So that's the first really important piece of information to find out. And the next thing you'll see is this part over on this side, where it breaks down and shows you for each age, what, if you file at that age, how much you will receive monthly. And some people may say, well, if it tells you all of this, why is it important to know your full retirement age? And that's because a lot of these numbers, as well as some of the other numbers we'll talk about later, are based on what that full retirement age is. So for instance, first of all, the earliest you can file for Social Security is age 62. And then it really doesn't keep going up after age 70. So there's really no reason to wait till age 70, because it's not going to give you any benefit to wait. But in this case, age 67 is their full retirement age. And you can see for this particular person, their benefit would be $1,500 a month at their full retirement age. For every year that you file early, it's approximately 6% less than than your full retirement age. So for every year you file early, you'll get about 6% less. But the converse is true. So for every year that you wait, and this is even a little better, you will earn approximately 8% more. Your benefit will be about 8% higher for every year you wait past your full retirement age. Okay. So those are a couple important things to know about this page. And then the last thing I want to show you is on this bottom paragraph on the left side, where it says these personalized estimates are based on your earnings to date and assume you will continue to earn, in this case, about $52,000 per year until you start your benefits. Now, why that is important is, again, what is on your statement is only an estimate. It's not the actual amount you will definitely receive. So this is assuming that you continue to make that much money, the $52,000, until you retire or you start collecting your benefits. So if you get this statement and all of a sudden stop working, then your benefit may not be this high. It might be a little lower. If after you look at your statement, you start making a great deal more money per year, then your benefit will gradually increase as you work. So it is important just to remember that that's only an estimate. Now, the other part to look at on here is your earnings record. And this is another reason why we feel like it's very important for you to look at your Social Security statement, is so that you can check for any errors in your earnings record. Now, on your actual statement, you'll notice that for the first few decades, they just average it out and show you how much you've earned over that decade. But there is a place on ssa.gov to click that you can see your full earnings record, where they will show you every single year how much was reported as earnings for you. Again, the reason this is important is because this is where your benefit is going to come from. They're going to use these numbers to get that average of your highest 35 years. So you want to make sure that you're not looking at this and all of a sudden see in 2007, you see a zero and you think, I was working full time in 2007, so my wages should have been reported. So you want to be able to get any errors corrected. And we encourage people to look at their statement and their earnings record at minimum every 2 to 3 years, because if you do find a mistake, the easiest way to correct it would be to show your tax return, which if you're like me, you may keep your tax returns forever and have them from the time you became an adult. But some people like to get rid of them or not have them handy. So you want to be able to get that earnings record corrected while you still have those tax returns easily available to you. Okay, it does look like we have a question, so I'll stop here before we go on.
Great, thank you, Renee. We actually have a couple questions. One question is from that chart that you showed at the very beginning, from the number of current workers compared that we're funding into Social Security, and when that decrease might happen. Someone is asking, did you generate these numbers before all the people took early retirement during COVID? And how that might affect that decrease.
These were numbers from the Social Security Administration in 2022. So they were from probably about the beginning of 2022 is when those numbers came out.
Okay, thank you.
No problem.
And, another person, I'm just going to go ahead and read this. It says, once we accumulate 40 credits, the assumption is that we don't need to worry about getting more credits to increase the amount of Social Security benefits that the person will get. Is that correct?
The 40 work credits gives you the eligibility. That just decides that, yes, you can receive Social Security. But the more you work and the higher your earnings, the higher the monthly benefit will be. So, you know, those 40 work credits, all those do are make you eligible to receive benefits. But the, you know, more of those 35 years, or even if you worked 35 years, if you can replace one of those lower earning years with a higher earning year, that's going to bump up your monthly benefit.
Great. I think that clarifies that. Thank you.
Sure.
And then there's one more question here, and I don't know whether we want to answer this one or now or maybe a little bit later, but the person asks, if I recharacterized my IRA, which shows up as income, is that included in the yearly money earned?
I'm not sure if they're referring to like when we get to collecting while working, but your IRA benefits do not count toward how much you can make by working if you file early, which we're going to be talking about later. So I'm not positive if that's what they're referring to, but if that's what they're referring to, then retirement benefits are not included in how much you can earn without going over the limits for Social Security. But we'll get into that in a lot more detail later on.
Okay, fabulous. And just a reminder to our participants, if you want to delve into a question a little bit further, or maybe ask something a little bit differently to make sure that you get your answer, please just enter the question again, and we'll be sure to get to it. But for now, I think I'll let you forge ahead, Renee. Thank you.
Okay, we'll get back to where we were. All right. Let's start by talking about filing strategies for individuals. And the first thing I want to point out as we're looking at this chart is this really is mainly for those who are single, because those who are married or even eligible for ex-spousal benefits have some other options to consider. But this kind of just gives us a starting point for deciding at what age to file. Now, what age you file is going to depend on multiple things, not just this chart. And considering the information on this chart, you have to consider what other income you have available, what investments you have available, your expected, how long you expect to live based on, the longevity of your family, whether you have any chronic illnesses. All of those things can play into your filing age and when you choose to file. But this kind of just gives us a break-even point that I can show you regarding when you file. So in this particular case, this person has a full retirement age of age 66. And at age 66, their full monthly benefit would be $2,000 per month, or $24,000 a year. Okay. So what we want to know, because if they decided, oh, I'm not going to wait till age 66, instead, I'm going to file at age 62, how much money or how long does it take to make up for not filing at age 62 if I wait till age 66? Let me break that down and show you what I mean. So at age 62, they would only receive $1,500 a month. And that $1,500 a month turns out to be $18,000 a year. So from age 62 until age 66, they would be earning $18,000 a year if they filed at age 62, or over that total time, they would earn $72,000 over that full 4 years. So the question is, if they've left $72,000 on the table, how long is it going to take to make that back? Okay. So if you will notice, since it's $500 a month difference, that means it's $6,000 per year difference. So we take that $72,000 that we have left on the table, divide it by the $6,000 a year, which is the difference in income, and we get 12. So that means it's going to take us 12 years to make up for that money that we left on the table if we wait till age 66. So it's not until we get to age 78 that we break even. And it's after age 78 that you're actually making money from that decision. Now, in the same respect, we can look at the difference between age 66 and age 70. So if we wait till age 70 to file in this particular case, then we have left $96,000 on the table from age 66 to age 70. And again, it's going to take us over 12 years to earn that back, or until about age 82 and a half before we would make that back. So that's not going to tell you, this is definitely when you should file. You should definitely file at 66 or definitely file at 70. It just gives you an idea of where those break-even points fall, so you can get an idea of how much difference that's going to make. And again, for some people, they can't afford to wait any longer because Social Security may be their only income. Or for some, they're not going to file at age 62 because they're still working. So they don't want to lower their benefit while they're working, which we're going to be talking about later on. So it really is a personal decision, but this is just a way to have you start thinking about how those decisions affect your Social Security. All right, let's move on to filing strategies for married couples. So there are two filing strategies for married couples. You can either file on your own benefit or file for spousal benefits. Now, some of you may have heard of something called restricted spousal benefits, which you used to be able to do, but cannot do any longer. Okay, so with restricted spousal benefits, you used to be able to take your spousal benefit and let yours continue to grow, and then switch to your own benefit later after it's had time to grow. That is no longer an option unless you were born before January 1st, 1954. Okay. So that is those are the only people who still have that option. The rest of us do not have that option. So it's either I'm filing on my own benefits or I'm filing for spousal benefits. Now let's look at some examples, and we're going to look at Tom and Mary. So Tom and Mary are a married couple who, and for each of them, their full retirement age is age 66. So when Tom goes to file at age 66, they're going to tell him his full retirement age benefit is $2,500 per month. Now, when Mary goes to file at her age 66, they will look at her record and say, Mary, on your work record, your benefit is $1,200 per month. But then they will also give her an option to take a spousal benefit of $1,250 a month, which is half of Tom's full retirement age benefit. So Mary's going to look and say, I've got $1,200 on my own record, $1,250 if I take a spousal benefit. So she's obviously going to go with the higher benefit, which is her spousal benefit. So that's what she would receive going forward. Now you might look at this and be like, why is Tom's benefit so much higher than Mary's? And it could be the spouses are reversed. It could be Mary that's receiving the higher benefit. Or maybe you know that your neighbor down the street's benefit is estimated to be way higher than yours, or vice versa. That's because it's all based on that work record that we looked at before. So your spousal benefit is going to be based or I'm sorry, your work record is going to be where they take your benefit from. So if someone else's benefit is higher than yours, it probably means either they had a longer work record, so they worked for more time than you did. So maybe you only worked 25 years and they worked 35 or more years, or over that time, their salaries were just higher on average over their lifetime. One person may again have had some sick time that they took off, so they weren't able to work as much. All of those factors play in, and that's why you want to make sure that that work record is accurate, because you don't want to receive less than you are due. Now, let's look at another, well, before we look at some other examples, let's talk about what the rules are here for spousal benefits. First of all, you must be age 62 or older to qualify for spousal benefits. You must have been married for at least 1 year. So you can't go off to Hawaii on a nice vacation tomorrow and come back with a husband or wife and decide that you want to file for spousal benefits tomorrow. It doesn't work that way. So you have to have been married for at least a year to qualify. Your spouse must have filed first in order for you to receive spousal benefits on their record. Okay. And then again, if claimed at your full retirement age, which we'll get to in a little bit, the spousal benefit will be 1/2 of your spouse's full retirement age benefit. So let's look at some other examples, and this might answer some questions that people may be thinking about. And we'll go through these examples, and then if you still have questions, I'll stop and take some at that time. So now let's think of a different scenario for Tom and Mary. Okay, same full retirement ages, same full retirement age benefits. But let's say Tom decides that he wants to wait until age 70 to file. So he goes into Social Security at age 70, and they say, Tom, now you are eligible for $3,300 a month because you waited to file. Now, if Mary goes in at her full retirement age, which is age 66, she is only going to be offered the benefit on her record, her work record, because if you notice here, Tom has not filed yet. So she will only be able to receive $1,200 a month because Tom has not filed. Now, a year later, when Tom does file, then they will bump her benefit up so that she receives that extra $50, and receives half of his full retirement age benefit. But notice also, I did not say that she's going to receive half of $3,300. She would only receive half of this $2,500, because your spousal benefit can never be more than your spouse's full retirement age benefit cut in half. So now you may receive a little bump up or bump down from that amount based on whether you file early or late yourself, but your benefit is not going to be half of your spouse's benefit if your spouse waited to age 70 to file. Now let's think of another scenario. Let's say Tom decides he's going to file at age 62. So Tom files early, so they're going to lower his benefit to, let's say, $1,800 per month. So Tom files at age 62, he's receiving $1,800 a month. Mary waits till her full retirement age of age 66. She goes in and they say, Mary, again, your benefit on your record would be $1,200. Your spousal benefit would be $1,250. And she's going to get her full $1,250 spousal benefit. That is because she waited till her full retirement age to file. So as long as you wait till your full retirement age, then your benefit, whether it's your benefit on your own record or your benefit on your spouse's record, is not going to be reduced just because your spouse filed early. Whether it's reduced or increased is based on when you file. All right, last scenario we're going to talk about here is what happens if Tom goes in to file at age 66 and Mary decides she wants to file at the same time. So instead of waiting till she turns 66, she wants to file at the same time as Tom. So she's filing at age 63. So that means that Tom's filed already, so she qualifies for spousal benefits, but she's filed 3 years early. So again, they're going to start at that same starting point of Mary's full retirement age is $1,200, or full retirement age benefit is $1,200. Her full spousal benefit is $1,250, but then they're going to reduce that $1,250 by 18% because she filed 3 years early. All right, this would be a good time to see if anyone has questions.
Yeah, that might be a little confusing. And so while people are thinking about maybe a question that they might have, let me just read an observation from someone is just that your scenario is probably more accurate because in the professional world, women are often making less than their male counterparts at work. So often their retirement benefit is going to be lower. I don't know if anyone else has questions, just so that I can clarify. So the spousal benefit does not change if the spouse retires early or late, as long as you retire at your retirement age. Is that correct?
Right. So, and I think I'm understanding your question. So, for instance, it doesn't matter in this scenario if Tom files early or late. Mary, the most she could ever receive, other than waiting a little bit, is half of his full retirement age benefit. So if he waits again till age 70 to file, she's not going to receive half of his age 70 benefit. She's always going to receive half of this 2,500 benefit, but as long as she waits till her full retirement age. So it's based on when you file, as far as that goes, as long as your spouse has already filed. Okay. Did that clarify it? I know this gets very confusing.
It does. And someone is asking, are there different slides to show these different scenarios, or you were just talking us through these?
I was just talking through based on these two numbers, but what happens before or after. But no, I don't have like a separate one showing 3,300 or 1,800.
Okay, but if our participants have more questions, please feel free to go ahead and put those in the Q&A, and we'll revisit this because it is a little confusing.
Yes, it does. It does get confusing, and between Social Security and the IRS, they do not make these things easy. So I completely understand if you get confused, because they do get confusing. But yeah, feel free if you think of a question later, we'll talk about it again.
Okay, well, for now, we'll let you forge ahead. And just a reminder to people to go ahead and enter those questions if you're still muddled, like I may be a little bit. Go ahead. Thanks, Renee.
Sure, no problem. Okay, let's talk about ex-spousal benefits. So as a divorced spouse, you may be entitled to Social Security benefits based on an ex's work record if you were married for at least 10 years, you are age 62 or older, and your ex-spouse is 62 or older, and you are unmarried. So it does not matter if your ex-spouse has remarried or not. That doesn't have any effect on whether you can have ex-spousal benefits. The only thing as far as marriage that matters is that you are unmarried. You are not married when you go to file. Okay. Now, one thing you'll notice that's different with ex-spousal benefits is it says that you are older or 62 or older and your ex-spouse is 62 or older. In this case, you don't need to know whether or not your ex has filed for benefits or not. This is something that Social Security has done that's very smart, because most people who have gotten a divorce have had some sort of conflict in their relationship. So they may not be in communication with each other, or, if they are, it might not be a pleasant communication. So you don't need to know this. And this prevents someone like from holding a grudge against their ex-spouse and be like, I'm just not going to file because I don't want them to be able to file. It takes all of that drama out of ex-spousal benefits. So all you need to know is whether your ex-spouse is 62 or older. If they are, then you are eligible. And the rest of it works very similarly to how the spousal benefits work. So again, if you wait till your full retirement age, you would get half of your ex-spouse's full retirement age benefit. And as long as you have things like your marriage certificate, divorce decree, things like that, that you can take in to show Social Security, then they will be able to figure out whether your benefit is better or your ex-spousal benefit is better. Survivor benefits. So the survivor benefit is based on the earnings of the person who died. A reduced survivor benefit is available as early as age 60. But again, how we talked about how there are reductions for working, which we'll get into in detail, that is something you have to consider if you're thinking of taking your survivor benefit at age 60. Any time that you file prior to that full retirement age, there are limits to how much you can make before reducing your monthly Social Security benefit. And we'll go into those details in a little while, but that's just something to keep in mind. Your full survivor, you will receive your full survivor benefit if it's claimed at full retirement age. If you remarry before age 60 and you are still married when filing for benefits, you will forfeit your survivor benefits. Okay, so that's another thing that's important to know. And then one thing that's really special about survivor benefits, and this is the only time you can still switch, is when you are eligible for survivor benefits. So you can switch from survivor benefits to your own benefit or vice versa at any time. So for instance, maybe I decide at age 60 that I'm going to take my survivor benefit and let my benefit on my own record continue to grow until age 70. And then at age 70, I switch off my survivor benefit and take the benefit on my own record. That is something that you can still do for survivor benefits. So that's something that's important to know. Now, speaking of survivor benefits, I want to talk to you about something that we encourage, if possible, for our clients. And that is, if we have a married couple, we will often encourage the lower earning spouse to take their benefit either at age 62 if they're no longer working, or as soon as they stop working, and the higher earning spouse to wait until age 70 to claim their benefit and let that benefit continue to grow. Now, again, this doesn't work for everyone because some couples need both benefits in order to just survive and pay their bills. But if it is a possibility, we do encourage that. And it's because of survivor benefits that we do that. And let me explain why that is. So for instance, if I was receiving a $1,000 benefit, monthly benefit, and my husband was receiving a $2,000 benefit, and I passed away. When I pass away, my benefit, the lower benefit, is going to go away, and my husband will continue to receive his $2,000 a month benefit. We reverse that around. Same idea. My benefit's $1,000 a month. His is $2,000 a month. This time he passes away. Again, whichever is the lower benefit is going to go away. And now I will receive his $2,000 benefit going forward. So if we have a couple who are married and they can do it that way, then they can start collecting that age 62 benefit for as long as they can, so that they are reaping the benefits from that and making some money from that, because we know that eventually, after the first spouse passes away, that benefit is going to be gone. And we want that age 70 benefit to, or, if possible, to wait to claim that age 70 benefit for the higher earning spouse, so that whichever spouse is the survivor will have more to live on and will have a higher monthly benefit when there's only one benefit left coming in. So that is just one suggestion that we usually make for our clients to at least consider if they are a married couple. Okay, I'm just going to stop real quick to make sure we don't have any more questions, anything to do with spousal, ex-spousal, or survivor benefits before we move on to a totally new subject here.
There aren't any more questions right now. We may still be ruminating on all that, but why don't you go ahead at this point?
Okay, thank you. All right, let's move on to the windfall elimination provision and government pension offset. These are two things that apply only to people who will be receiving a public pension for which they were not paying into the Social Security system while they were working at that job. Some very common situations where this occurs is those who are paying into the teacher's retirement system. They're paying into teacher's retirement, but they are not paying into Social Security at that time. Or some people are will receive SERS, which is a retirement program for those who work for community colleges. Things like that are what this is talking about. It could be a fire or police pension. I'm not talking about those who, if you worked for Motorola and are going to receive a pension from that, a private pension. That's not what we're talking about here. These provisions only apply to those who were paying into a public pension and not paying into Social Security at the same time. And again, since this doesn't apply to everyone, I'm not going to spend a lot of time explaining this, but if you have more questions about this at the end, I will stick around a little bit and try to clarify that for you if you need more clarification on this. So with the windfall elimination provision, the maximum monthly amount that they can reduce your Social Security benefit is $512 per month. And the reduction amount is based on your eligibility year, which is the year that you turn 62. And this applies when you have 20 years or less of substantial earnings in which you paid into the Social Security system. Okay. So if you have worked for 20 years or less where you have paid into the Social Security system, but you did pay into a public pension, then that's who this applies to. And again, the most they can do is reduce your monthly Social Security amount by $512 per month. Now, if you've worked more than 20 years outside of whatever job you were receiving the public pension from, but less than 30 years, then this amount will gradually decrease. And if this applies to you, there are calculators on the Social Security website that will help you come up with how this will affect your earnings. If you have worked outside of whatever that public pension job is for 30 years or more, then this does not apply to you at all. Let me give you a quick example of how this would work. So let's say you were age 67, or you had a full retirement age of age 67, and your full retirement benefit was $13.96. And you decided that you wanted to file for Social Security at age 62. They would take your full retirement age amount of $13.96, take out that WEP reduction of $512, and you would end up with $884. Then they're going to multiply that by 70% because you have a 30% less benefit due to filing early, and you will end up with $618 per month as your monthly benefit from Social Security. And then you would be receiving your pension beyond that. Now, without the WEP reduction for this particular person at age 72, they would have received $977. Now, let's say they waited till age 70 to file. Again, we're going to start with those same numbers. Their full retirement age benefit was $13.96. Then we take out that $512 WEP reduction and get that $884. Now we're going to multiply that $884 by 1.24 because they get a 24% delayed credit. So their benefit would be $1,096. And that is with that WEP reduction. Now that same person, if they would have filed at age 70 and they weren't subject to that WEP reduction, would have received $1,731. So that's just a quick walkthrough of how that works. But again, if that applies to you, there are calculators online at ssa.gov to help walk you through that. Now, the government pension offset applies to that same group of people, but this has to do with your spousal benefit or survivor benefits. And they can reduce your spousal or survivor benefits by 2/3 of the pension earned in non-covered employment, which is those public jobs. So let's look at some examples here. So in this case, we have someone whose government pension amount is $3,000 per month, and their regular monthly spousal benefit from Social Security would have been $2,000 per month. What Social Security is going to do is they're going to take that pension amount of $3,000 and multiply it by 2/3, which in this case is $2,000. And they're going to subtract that from what your normal monthly spousal benefit would have been, which in this case was $2,000, which means that you're going to end up with no spousal benefit in this case. And that is very common. So please be aware of that if you are receiving a government pension of some sort. Now, it doesn't always reduce it to zero. So for our other example, they're only receiving $900 as a monthly government pension. They're eligible to receive a $1,000 monthly spousal benefit. So again, we take that $1,000 monthly spousal benefit we take that $900 government pension and multiply it by 2/3, and we get 600. We subtract that 600 from our spousal benefit, and we end up with at least $400 of a reduced spousal benefit, which is better than nothing. So that's how that works. All right, let's talk about a couple of things that a lot of people don't know about. And the first one is something called retroactive benefits. So if you postpone taking your benefit past your full retirement age, and you go at least 6 months past your full retirement age, you can request a lump sum payment for up to 6 months of retroactive benefits. So for instance, let's say my full retirement age is age 66, and I wait till age 68 to file. I could go into Social Security and say, okay, I am age 66 and I would like to file, but I would like to request a 6-month retroactive benefit. So what they're going to do is they're going to give you one big lump sum. So let's say maybe your benefit amount was $2,300 a month. Okay. They're going to multiply that by 6. So they're going to give you a lump sum of about $13,000 right then. Okay. So you get this big lump sum check, or direct deposit probably these days. But there is a trade-off for that. So if you decide to do that, then they are going to set your benefit going forward. So your monthly benefit from now on, which is going to be what it would have been 6 months earlier. So you're going to get that 6-month lump sum, but then going forward, you're going to get the benefit that you would have received at age 67 and 6 months. Okay. And you cannot request retroactive benefits for any month prior to your full retirement age. Okay. Now, you might wonder, why would anyone want to do that? Well, it's usually a situation where having one big lump sum of money right now is more benefit to you than having a larger amount per month going forward. So maybe you have some other funds coming in monthly. Maybe you have a small pension of some sort coming in that will help supplement your monthly Social Security benefit. So that might not be a problem for you to have less money coming in monthly, but something's come up where a big amount of money right now would help you. For instance, your car breaks down, you need a new roof, you have a major medical expense come out of the blue, something like that where you weren't expecting to need a large amount of money, but now you do. This is one way that you could make that up. And then again, your benefit would be a little lower going forward because it would go back to 6 months earlier. The last provision like this I want to tell you about is what we call the OOPS provision. So if you decide to file for Social Security and within 12 months of when you file, you say, oops, I shouldn't have filed, then you can, if you have the money available, you could take the gross amount that you received from Social Security so far, pay it back to Social Security, and they will act as if you had never filed. So that's the last thing to do with that. So before we go on to collecting while working and talking about some cost of living increases, let me stop to see if we have any questions.
Yes, thank you, Renee. There are a couple questions, especially about spousal and survivor benefits. One person says, if my husband has an ex-spouse collecting benefits, if I have a point where I would be eligible for a survivor benefit, what does this mean for her and for me.
The good news is that it does not affect either of you. Okay. So when we're talking about ex-spouses, that does not affect how much your current spouse can receive or how much you will receive based on your husband. If you are receiving a survivor benefit, none of that. What the ex-spouse does not affect what you receive.
Okay, great, thank you.
Mhm.
And the other question was, other than survivor benefits, are there other circumstances in which an ex-spouse can switch from an individual benefit to the ex-spouses or vice versa?
Past your, unless you were born before January 1st, 1954, you cannot switch between a spousal benefit or ex-spousal benefit and your own benefit and back. The only time now that you can switch is for a survivor benefit.
Okay, all right. I think that answers all the questions we have right now. So we'll let you go ahead and finish up.
Okay, sounds good. Okay, really quick, let's look at cost of living adjustments. So Social Security does consider what is going on in the economy each year. So they will look at it and make adjustments based on what is going on in the US economy. So if you look way back here in 1980, there was a very large cost of living increase of 14.3%. But there are some years, like down here, when there was no increase at all. But the good news is that Social Security does pay attention to those things, and they will make adjustments as needed. You can see in 2022, we had a pretty large increase of 5.9%. And for 2023, they've just announced that it's going to be 8.7%. So there is quite a big jump that's going to be coming for Social Security recipients in 2023. Now, something to keep in mind before you get excited when you see a cost of living adjustment coming in is to also pay attention to your Medicare premiums. Most of the time, when Social Security benefits increase, so do Medicare premiums. Now for 2023, we're getting lucky that Medicare premiums are actually going down just a little bit for 2023, which is very rare. Okay. But most of the time, when you see that cost of living increase coming in, just make sure you check your Medicare, what the new Medicare premiums will be too, before you get too overly excited about that increase in benefit. Okay, let's talk about working while collecting. Now we're going to start with the very good news. If you are in the month of your full retirement age or after, so you're past full retirement age, then you can make as much as you want and still keep 100% of your benefits. Those benefits are not going to be reduced by any amount that you are working. Now, it will affect the taxation of benefits, but it's not going to reduce the monthly benefit that you are receiving. Now let's look over here at this first column where it says under FRA or under full retirement age. So if you are under your full retirement age, the most you can make without reducing your benefits is $19,560. So to make that easy, as we're thinking of a scenario to try to understand how this works, we're just going to call that $20,000. So basically, you can make $20,000 in a year and collect your Social Security benefits if you're under your full retirement age without reducing your benefit. Now, the question is, what happens if I go over that $20,000 threshold? So for every for every $2 that you go over that cap, your benefit is going to be reduced by $1. So let me give you an example. If I make $40,000 a year, that means I've gone $20,000 over that limit. So what Social Security is going to do is they're going to take half of that $20,000, which is $10,000, and reduce my benefit that year by $10,000. Now, they're not going to do it the easy way, which I would consider, and just take $10,000 divided by 12 and reduce my benefit by that much going forward. That would make too much sense for Social Security. So what they're going to do instead is, let's say that your original benefit was $2,000 a month. And again, they're reducing our benefit by $10,000 for that year. They're going to say, okay, $10,000 divided by your monthly benefit of $2,000 equals 5. So for the first 5 months of that year, you will not receive a Social Security benefit at all. And then starting in June, you'll receive your full $2,000 benefit for the rest of the year. And then if your situation is the same, that whole scenario will play out again starting in January, where you'll be back to not receiving a benefit again. All right. So basically, they take that benefit completely away until you get to how much they cut your benefit by. And then they'll start giving you the full amount for the rest of that year. So that keeps going until you get to the year that you are going to turn your full retirement age. And in that year, the threshold is $51,960. So to make it easier, we're going to call that $52,000. So in that year, they're going to take $52,000 and divide it by 12, okay, which is $43.30. And for however many months it is before your full retirement age, they're going to multiply that $43.30 by however many months. So let's say my birthday is in September. They're going to take $43.30, multiply it by 8 for the 8 months that fall before September. And that gives me $34,640. So I can make that much money in that year that I'm turning my full retirement age before my benefit would be reduced. Okay. Now, if I still go over that threshold, whatever that turns out to be for me, my benefit will be reduced, but it won't be as bad. So now for every $3 I go over that cap, my benefit will be reduced by $1. So that is how it works. But like once you get to that month of your full retirement age, then you're good to go. Your benefit will not be reduced. Now let's talk about the taxation of Social Security. The good news is, if you live in Illinois, the state of Illinois does not tax retirement benefits, whether it's Social Security, pension, IRA distributions. None of that is taxable in the state of Illinois. So for your state taxes, you don't have to worry about that. For federal taxes, they base how much of your Social Security benefit is taxable on what's called provisional income. So to come to your provisional income, they take your adjusted gross income, which you'll see on the first page of your Form 1040. They're going to add back in the non-taxable interest, which usually comes from municipal bonds. And then that adjusted gross income that they started with, they're going to figure, first of all, without any Social Security in there, they're going to add in that non-taxable interest. And then they're going to add in 1/2 of your household's Social Security benefit. And from that calculation, they get your provisional income. And I'll explain another way to understand what that means. So basically, your provisional income includes the sum, the total of your wages, your taxable interest, non-taxable interest, dividends, pensions, self-employment, or any other taxable income that you have coming in, plus 1/2 of your household's Social Security benefits. Once you know that number, from that number is decided how much of your Social Security is taxable. So if you are single, head of household, or married filing jointly, and your provisional income is below $25,000, then your Social Security income will not be taxed. Okay. If you're married filing jointly and that provisional income is below $32,000, your Social Security income is tax-free. And you might look at those numbers and think there's no way that anybody can live off of that. Well, there are some strategies, which we're going to talk about one in a minute, but you may be able to do this not every year, but maybe you could do it for a couple years if you have a big amount of savings built up, so you don't have to use IRA distributions or something like that to live off of, or if you're only living off of your Social Security income anyway. Or perhaps you have a brokerage account that doesn't have a lot of capital gains built up in it that you might be able to pull from for a year or two for any amount that you need above your Social Security benefit. Or if you have money in a Roth IRA because you've already paid the tax on that. Those are some options that might be able to keep you without your Social Security income being taxed. Now, on the other end of the spectrum, if your income is above $34,000 if you're single, or above, I'm not sure if I said 34, above $34,000 if you're single, or above $44,000 if you're married filing jointly, then up to 85% of your Social Security income may be taxable. Now it says up to 85% because Social Security does, the IRS does have a form that you have to fill out or have your accountant fill out. That's a worksheet that decides exactly how much is taxable. But the most of your Social Security benefit that can be taxable is 85%. So when you look at your Form 1040, you'll see like a place to put your gross Social Security amount, and then it'll have a line right next to it, taxable Social Security. Those two numbers should never match because you can never have more than 85% of your Social Security income taxable. And again, there's a worksheet with the instructions of your 1040 that walks you through that. Okay. And then if you fall in that middle category, then up to 50% of your Social Security income may be taxable. Let me just give you a quick idea so you can understand how this works. So let's say that your benefit was $2,000 a month and you fell within that 85% category. They would take your $2,000 a month, multiply it by 85%. That gives you $1,700. So that means $1,700 of that monthly benefit is federally taxable. And that's going to be taxable at whatever rate your tax bracket falls in based on all of your income altogether. So if you fell into the 22% tax bracket, they're going to take that $1,700, multiply it by 22%, and you'll get $374. So $374 goes to the IRS, and you're left with $16.26 to your checking account. But if your Medicare premiums are coming out, then those will come out, and then you will get that net amount into your bank account. Okay. Now, something to remember is that if you know your Social Security income is going to be taxable, you need to ask Social Security to withhold federal tax. And there's a form, and I know you probably can't see this, but it's called a W-4V. And the W-4V is what you will need to fill out anytime you need to make changes to your withholding for Social Security. Now, if you go into Social Security and actually go in person to file for Social Security, you can tell them that you want tax withheld. And they right now give you the choices of 7%, 10%, 12%, or 22% to have withheld. But if you're filing by phone, or you forgot to tell them that you want tax withheld, or you realize at the end of the first year, oh, I should have had tax withheld, I'm going to do that going forward, then you would fill out that W-4V, which you can find one online. They're very simple to find, but you can find that online, fill it out, and then you would mail it or take it into your local Social Security office. And then once they receive it, they'll make the adjustment and start withholding the tax. To give you one quick example here of a way to get under that provisional income threshold, let's look at an example of two couples. So we have couple one and couple two. They both make the same total income right here. So they both make $67,000. You'll notice their interest income is the same, dividend income is the same, tax-free bond interest is the same, Social Security benefit is the same. The only thing different here is that couple one took $25,000 out of a traditional IRA to pay for their expenses. Couple two took $25,000 out of their Roth IRA. Because couple two took the $25,000 out of their Roth IRA, that $25,000 is not taxable income, so it's not included in your provisional income. Okay? So their provisional income is much less, and the reason the Roth IRA is not taxable when you pull it out is because you have paid the tax on that money before you put it into that Roth account. Whereas with the traditional, you put that money in pre-tax. So when it comes out, it is treated as regular ordinary income and you pay tax at your federal tax bracket. So in this case, couple one will be in that 85%, where 85% of their Social Security benefits will be taxable. Couple two, only 0, or I shouldn't say only 0%, but 0% of their Social Security benefits will be taxable. Okay, let me tell you quick how we can help you, and then I will take some last questions if you have any at the end. So because you attended our seminar today, you have the option of booking a consulting session with the owner of our company, Mike Heatwell, who's a certified financial planner. And that's free of charge for you because you attended. The only thing we do ask is that you book that seminar within that session within 14 days. That doesn't mean that you have to come in within 14 days. If you can't make it in till after the holidays in January, that's fine. We just ask you to get that date on the calendar within 14 days. And what we'll do for you, again, and this is free to you, is we'll do a tax return review where we're looking for specific tax planning opportunities for your retirement. And we'll help you explore your Social Security filing options that are specific for you in your situation, whether you're married, single, um, eligible for ex-spousal benefits, survivor benefits. We'll look at all of those things and help you come up with the best strategy for you. Now, what you will need to bring to that is your full 2021 tax return, your Social Security benefits statements, which if you don't have those already, you can get off of ssa.gov. And then any investment account statements that you have already, because that helps us to see your overall picture by looking at all of these things so that we can help you walk through what makes the most sense for your filing strategy. Now, in order to do that, you can go to this link right here where it says Social Security Seminar Consulting Session Scheduling link. And I know Barry's going to be sending out some information after our seminar. So you'll be able to use this to do that, or you can always email me at rboyle@thedalagroup.com. And with that as well, after tonight, if you think of other questions that you forgot to ask or something comes to mind, always feel free to email me at rboyle@thedalagroup.com. All right, are there any further questions before we go for tonight?
I don't think so. Renee, thank you so much. We'll give people maybe one more minute here to enter any questions that you might have, but just to confirm, I am going to be sending out all of these contact links in the email that'll go out probably later yet tonight. So you'll have all of that easy, and you'll just be able to go ahead and click on those. I'll also send out the link that takes you to the YouTube page on the library's the library's YouTube page that has all of those other recordings of programs that might be interesting to seniors as well. If you would like to receive these links from me and you're watching the recording of this program, you can just email me at ce@wheatonlibrary.org. That's CE for Community Engagement at wheatonlibrary.org, and I'd be happy to send those resource links out to you. It looks like people have had another minute and no other questions have come in, so we'll assume that we're good for tonight. Thank you again so much for your time, Renee, and thank you to the Dala Group for providing this program. With that, we'll say good night, everybody. Take care, and we'll see you again soon.